So we are live. Hey, everybody. Happy lunch hour to all the investors and freedom seekers. François Lanthier from FL Homes Corporation with my friend here, Charles. Charles, can you introduce yourself? What do you do?
Yes, please. Thank you. Thank you again, François, for having me. As François said, my name is Charles. I am a mortgage and lending specialist just outside of the GTA. And yeah, we're on. François invited me on. We've done a few projects together in terms of collaborations in the past, and we're just on here to talk about just some of the rules and regulations, the lending climate, etc. And hoping just to bring as much value as we can to this live.
Yes, so I'm very excited. I know when I posted about the event, I said mortgage rates went down, but actually they went up. Should we be concerned? Are we going to start losing our houses and properties? It's going to go up to 28%, or what do you see, Charles?
No, definitely not. I wouldn't bet my bottom dollar on that at all. It's as we talked a little bit on the phone last night, what it is, right? Because obviously the Bank of Canada sat down. What was it, 2 or 3 days ago, to see if they were going to move on the qualifying rate, right?
Yes.
If they want to bring it down or keep the same. So they decided, at least for the start of this quarter, they were going to keep it the same. And a response to that, what we saw was RBC being the first big bank, and actually probably the number one A bank when it comes to lending. They increased their rates, not by much. All right, I think it was about 15 bips, not even 0.25%. And then TD follows suit, right? So a classic scenario of monkey see, monkey do. Again, that's just to increase
big
the profit.
monkeys, though.
Yeah, no, exactly. Now, have I heard of anything else? No, not as of yet. No other big banks, none with broker channels, have decided to follow suit. So as of right now, those are the two big players that have increased the rates accordingly based off of the Bank of Canada response. Now, would I go on the limb and say the rest of the banks are going to follow suit? Honestly, I don't think so, because then it doesn't make it as competitive, right?
Yeah,
so
exactly.
So I'll bet my bottom dollar for the majority of them, they're going to stay relatively the same moving forward.
Perfect. And this afternoon, we want to call this Market Mayhem. So it's a nice title you gave it, because these markets are crazy. It's not as bad as the stock trading and all that, but things are going up and down. You mentioned something interesting while we were on the phone the other day before Christmas. So rates actually dropped quite a bit.
Yeah.
And it looked like banks wanted to close some deals before the end of the year. So that's an interesting thing as well, if you could share that.
Yeah, so 100%. And we see this all the time, right? So I think it was CIBC, if I'm not mistaken. What they did was literally the last month of the quarter, right? To the end of the year, they dropped their fixed rate down to almost nothing. I believe it was in the 1.3s.
Wow. That's dirt cheap money.
No, 100%, right? And that was to get some last minute business before the year end. Why not, right? And what that did was it forced all the banks' hand to kind of see what they would do. Would they try to match and bring it down quickly? That way they don't lose that last quarter business, or will they kind of just hang it up and just wait for the new year, right? Now, obviously, CIBC has brought the rates back up, because that's not realistic to hold off. So that promotion is already dead. And the rates are back up to competitive than what you've seen with some of the other A lenders, right? HSBC was another one that dropped their rates for the first time we saw below 1%. So 0.99 was what the articles read. Again, same thing, that's back up now as well, right? So that happened in December. Again, to collect that last minute business, but like everything else, they can't stay that low because profits, right? It's not
it's not sustainable. Yeah, that's it. But one thing that's very interesting, so we talk about rates. Rates are great, very important, but for an investor, their rate is good, but you have to plan your project out quite well also. So what about terms? Because that's something that's often overlooked. You're lured in by this crazy rate, 0.99 or 1.5 or something very low, but then the terms. So can you talk to us about terms?
Yeah, for sure. So And this is actually something I kind of picked up from you in our first live that we did together over Instagram.
Oh, cool.
Yeah, you really, because you mentioned that a lot of your JV deals you do for 5 years, because 5-year term, and then you decide whether you want to dissolve the partnership or keep going, whatever the case may be. And I tell people that, especially if you're coming in it from an investor mindset, you do want to make sure that you are looking over the next 5 years, because what that does is, first of all, it's going to allow you to know whether you want a fixed or variable. Reason being, because if you go into a variable, you know if you decide to break within that 5-year term, it's only going to be 3 months interest with it, which is generally inexpensive when you compare it to the interest differential, which it may be if you do a fixed, right? Because whenever you sign a fixed for the 5 years, it's generally a choice of interest differential or 3 month interest, whichever one is higher. Interest differential, it tends to be a little bit heavier on the pockets when you want to break, right? So I would say that's the first thing you want to look at, because if you know, like, you know what, in the next year or so, I am planning on refinancing, taking the equity out, all right, and then applying that to another investment, well, then variable 3 months interest would make more sense, right?
Yeah. Especially if you do the BRRRR strategy and you're going to buy it, you're going to fix it. So within a year, you're going to want to refinance, a year, 2 years, or even way sooner, hopefully. So the importance of like refinancing, yes, with the same bank or maybe another bank. So you need to plan with your mortgage broker very carefully. There's other interesting terms as well. Sometimes there's prepayment privileges, other things that people often overlook. And now when I get a new mortgage, I read like line by line, what's in this, what's in it for me in this thing, and how can I leverage it and use all these favorable terms.
Exactly, right. Prepayment privileges is another big one, right? Being able to put, generally the rule of thumb, most banks will allow 20% lump sum overpayment on a yearly basis, some a little bit more, right? Again, that's if you want to pay down the mortgage a little bit quicker too, right? To build more equity up in the home, that's an advantage as well. Or even, let's say, from a burst strategy to, let's say, a flip, you're going to be in and out, let's say, in less than a year. Let's say, for argument's sake, you may not want to go to the private route and you want to stick with your conventional lenders. Well, an open mortgage may be beneficial for you because, yeah, the interest rates may be higher, up to 4 or 5%, but there's no penalties to break because that's it, a mortgage, right? So figure out your investment strategy, whether it's a long-term hold, a BRRRR, or you want to do a flip in and out, will dictate, again, how you want to what type of mortgage you want to sign up for, right? And obviously that's a conversation you want to have with your super team, your investment team, your mortgage team, your accountants, your lawyers, all that fun stuff, right?
Absolutely. Yeah, and disclaimer, like, well, Charles is a mortgage broker. I'm not, so I'm just an investor. I'm asking questions. My advice, do your due diligence. Very important to do it. We're just giving some opinions and things we're seeing today. We have a question from one of our viewers. So what about closing timeframes? Yeah, I'm hearing a lot of complaining about this, that it's taking way longer during COVID. It's hard to get approved, especially commercial, but residential as well. It's really hard.
100%, François. And I can't see who asked the question, but I will say that's a fabulous question. And this is a really important conversation to have with whatever mortgage specialist you're working with on this project or transaction. What I like to do with my clients is, given the market, we have to understand that all the 8 lenders, they're backed up.
Yeah.
Right? You have only a small underwriting team with thousands of files coming in every day.
Oh my.
Right? Especially with real estate investors, let's be honest, one real estate investor is putting offers on how many deals on a weekly, monthly, heck, even daily basis, depending on how much capital or JV partnership you have, right? So that's the first thing. So automatically they're going to preface closings that, like, offers on houses that are closing right away, right? Yeah. And that's their first priority. So already, I like to say you want to budget at least, in this climate, 7 business days. And that's 7 business days at the time of submission. So we have all the documents prepared, and we're putting now the file through 7 business days before you get the full approval, solicitor conditions approved, etc. Now, if this is a closing or refinancing or renewal happening down the line, you're putting down the back burner. They're not even looking at it, right? So we're putting in the documents now, submitting it. If the closing's not happening right away, it could be 2-3 weeks before we even get an initial response saying yes, the file has been picked up and we're going to now satisfy these conditions, etc. Right? So that's definitely a conversation you want to have with your broker in terms of a realistic time length, because the worst thing is if you have to push back closing or something like that based off of a miscommunication between you and the specialist you're working with.
Exactly, especially if you're doing the BRRRR strategy and you want to extract money to buy your next property, and the next property is kind of timed with this. It's very hard right now. I'm seeing like money being stuck for months months.
With a refinance, honestly, I would say minimum 2 to 3 weeks.
Okay, minimum,
from start to finish, 2 to 3 weeks. And as a mortgage specialist, I wish I could speed up the process, but we're essentially just the middleman, right? We can do our due diligence. We can check it out. We can message the banks every day. I can message the underwriters. Have you checked the file? Have you checked the file? Right? But it's really, once we submit the files and gather all the documents, it's really up to the bank now. And right now, what I'm seeing in today's climate, for a refinance, 2 to 3 weeks. So I'd be careful if you're doing the BRRRR strategy and you have another property that's lined up right away. We might have to entertain, maybe closing it private or on the B side, or maybe until you get the funds, and then we can finance it over on the other side, or a bridge loan, or whatever the case may be, right? We've got to have those alternative options set up just in case.
That's smart. And we have a comment here from one of our listeners. So Rachel Shea, my realtor in Ottawa, she says it's a really tough in this fast-paced market. Most offers in Ottawa have no conditions, which is true. So no conditions. You're like, okay, how do I get financing? So you just have to go by faith, or or get a private lender lined up, or how do you prepare for a no conditions market?
No, 100%. And this is something, even me being in the GTA, we get all the time, right? Ottawa, GTA, those are hot markets.
Hot markets, yeah.
Hot markets, right? So what my advice would be, again, even though to give my sound advice, I can never advise a client to put no conditions, because just in case they can lose their deposits. But for the sake of this conversation, if we're going to go that route, you want to make sure you have all your loose ends tied up with your mortgage specialist. So that means whatever documents they ask for, all right,
they're submitted.
Make sure they have everything they need in order to now give you an educated decision or opinion, so that yes, you can go ahead and waive conditions because we can get financing, right?
Yeah.
If you have a closing that's coming up, and let's say it's 8 business days away or 6 business days away, and your mortgage specialist has no documents, or all of them, hasn't been able to give you a proper pre-approval or anything like that, I wouldn't advise it, because it's just not safe, right? Because then we're taking more of an best educated opinion based off of the small conversations we've had. But for me personally, I won't do it unless I have everything I need, the full picture.
No, that's smart. And I invest in out of province as well. Some provinces actually, like in Quebec and Brunswick, they need that letter of commitment. If not, you can't waive the condition. In Ontario, you can just waive it and hope for the best. But in those provinces, you have to prove it. Maybe it's not the one you're going to end up with, but it is the one that you're using to waive the condition. So you need that letter. If not, you're not out. So it's very hard.
I didn't even know that. And it makes sense, right? Because I can tell you how many times people waive the conditions.
Yeah, surprise, you're not approved.
And so we actually surprised. So, and then now we have to entertain the private route, etc. If you really want the home, right? To make sure.
Well, I'd like to learn more about that because I deal with private lenders oftentimes for deposits or loans or joint venture partnerships or like short-term purchases, and then like sometimes you'll finance a BRRRR with 100% private funds, and then finance or refinance with a bank. So that's a good way. So do you have access to that kind of capital?
Yeah, no, 100%. Me personally, I love private lenders. I love, especially yeah. It's a lot easier on the broker side because they don't really look at credit report that much. They'll look at it, but it's not the underlying of, or basis of the decision. They'll look at income, right, and the portfolio of the borrower. But their main concern is really the property, where it's located, and the equity in it, right?
Okay.
That's what we call equity lenders. That's their main cause of concern, right? And if obviously they're taking a first or second position. So yeah, I work with a plethora of different private lenders, and I've been able over the last couple months build some really sound relationships with some of the big private lenders in the real estate game right now, specifically investor-minded private lenders. So quick shout out to Calvert out west. I'm not sure if you've done any work with them, but
yeah, I've seen you've interviewed them, and I'm interested because I am looking out in Western Canada, so that could be interesting.
So they do a lot of financing in Ontario, specifically flips, right?
Okay.
Reason being because obviously doing a flip, it requires a lot of capital, right?
Yeah.
Full flip. So what they have a niche product specifically for those who are doing flips, where it allows you to get into a full flip with only $20,000.
Wow.
So yeah, not 20%, but $20,000.
$20K regardless of the amount.
I believe it's up to 800,000 or $1 million. Don't quote me on that, but it's pretty high.
I will quote you, guaranteed. I'm just kidding. Because I actually have I do some coaching and some mentoring, and I have some students that do flips, and they are looking for money and stuff. So I'll have to tell them about this program. I kind of forgot about it.
100%. What I can do is I can even send you like the brochure portfolio to whoever's watching, to yourself, that you can provide with your students as well. No, 100%. I can do that right after the call. And what I like about their product is they just don't just give you the money, right? They'll actually coach you through the numbers. So they have their own flip analyzer, Excel spreadsheet that they'll provide you to fill out. All right.
Amazing. You know if it's a good deal or not, because that's a big question. People like in Ottawa or GTA, they want to do flips, and they're like, is this worth it? Oftentimes it's not. So this will really tell you. I mean, your lender will not lend unless it's a good deal. So if they lend, then it's a safe bet. I mean, pretty safe bet.
No, exactly, right. And that's what I love about Calvert, because they are deal oriented, right? So they're actually going to do the due diligence with you in order to make sure and find out if this is a good deal. So they'll give you their flip analyzer on the house, right? That way you can punch in the numbers with them, all right? And pretty much come up with an answer to see if this is a good deal or not, right? And then from there, they'll lend on the deal, right? So that's
amazing.
They'll lend on the deal, not necessarily if your credit's horrible, you don't have enough income. Obviously, those things help, but they lend on the deal first, which is obviously great to hear for flippers, right?
Absolutely. And to keep going in private lending, so a lot of people don't realize that they can become private lenders themselves. Oh, yeah. Like right now, people are looking for passive income or secondary income because it's been hard. A lot of businesses have been hit. So a lot of your clients, I'm sure they have nice lines of credit. There's some nice products as well. I know Scotia has the STEP program where, you're the expert. I'm sure you could explain it better than I can.
So, so just to hit the nail on the head, right now, obviously with the economy and COVID, a lot of people are trying to find different ways to create passive income, right? And what I've been seeing is an uptick in individuals like ourselves. They don't realize that, oh, wait, I have these massive lines of credits, or I have big, hefty lines of credits.
Even if they're not that big, like 50K, 25K. I mean, you never know how, like what somebody needs. So
no, exactly. Like, I can actually be the bank. I can provide the financing. And just to break it down mathematically, just to make it understandable for the viewers, like if you have a line of credit that's, let's say, prime plus 1 or 3% or something like that, right? And you come across a private deal and let's say someone needs 50K, right?
yeah.
Generally, what the rule of thumb is for the amount of the deal, you can charge anywhere from 2 to 3% as a lender fee. That's on top. All right. On top of that, private money right now is going for about anywhere between 6 to 9%. But that is within your control. You kind of choose what your rate of return, like what industry can you choose how much you're going to make off a deal, right?
Yeah, here's my salary. I pre-negotiate it.
You know, exactly, right? So you said, I want to make based off of the inherent risk of the deal. I want an 8% fee. That's what I'm comfortable with, right? Well, you've made your 2 to 3% off your lender fee. That's one. And then now you're getting a monthly payment, right? Of 8% return on your money. And the great thing apart about it is why private lending is so safe in real estate, because it's secured against an asset, it's secured against a property. Not too many people are going to default on those payments because obviously if worse comes to worse, well, if you're in first position, you're in a position now to potentially take over the property if that's what has to come to, right?
Exactly. No, that's amazing, because I tell people all the time that you don't realize all the power you have. Like, it's just sitting there, and you can even have unsecured lines of credit. Those are a little bit more expensive, but those are still interesting and can open up great avenues to build some capital and increase your wealth and help you during tough times like right now.
100%.
And how do you qualify for those? Like, how does it happen? Like, how do you get a line of credit?
Well, I would say you want to be working with someone who can get you the deals and provide you with the individuals looking for these quick private loans or private funds, right? So connect with your local mortgage specialist or whoever is being referred to, right? Because they're the people who are going to be able to construct and quarterback the deal, for lack of a better term, right? And actually tell you, what, this is a pretty good deal. It's in a good area. They're looking to do, they need 50K for renovations, right? You can charge this amount. This is the fair interest rate on this. You'll have your money back within 6 months plus interest. And then the mortgage specialist puts the deal together, and you kind of just sit back and collect, right? And it's a registered charge against their property. So
so this would be a second mortgage or a first, depending, or even a third if the deal supports it.
Right. And at the end of the day, if you have to go again first, second, third, the interest rates go up, right? Because
exactly.
You're taking a riskier position. So just to break that down, if you're in first place right now, first position, I should say, private money is going from anywhere, I would say, as low as 5%, maybe like 4.5, to as high as 7, 8. Second position, you're looking, again, probably anywhere up to 13, 14%. And then third position, you're almost like an unsecured line of credit, like 15 up to 20 potentially.
Almost a credit card.
Yeah.
So third, I mean, is really for really short-term flips or something.
Yeah, exactly.
Urgent. There's other ways to finance your deal too. I mean, let's say you own a place and you need to extract cash. You could do a joint venture and have your partner pay to be in the deal. So that's another way. I mean, this is not involving you, but that's a way to pull out some money from a property and then maybe lend that out.
Exactly. And this is what I like. Sorry, I should preface my words. This is why I like when we do group projects with individuals, because you start to find a way now, given the economy, it forces you to think outside the box.
Yes.
Right?
No choice.
It forces you to. Yeah, you have no choice now, because obviously, jobs are a little bit hurt, security, etc. Right? Income isn't that strong for a good percentage of the population. And people still want to get into real estate. So it forces you to think outside the box in order to provide the finance you need, right? So again, that's right, to having a mortgage specialist that can kind of, sorry about that, kind of quarterback those kind of transactions are important, right? Because they can bundle the deal together and okay, this is what we can, this is what we can to, et cetera, et cetera.
Yeah, it's something that some people don't realize, especially more on the commercial lending side, is you can buy more than one property at once with one mortgage. So that's something that it's got advantages, especially commercial. You use the net operating income to qualify. So if you have more than one building, then that can really help build your case and the amount too. Like commercial under 500,000, they're not interested normally. So
yeah, no. Again, that's a really good point, François. Because again, what people don't understand, 5 units and up, that debt load, that mortgage is no longer under your personal name as François Lanthier, right? It's under the whole property now, because that's seen as a separate entity. So when we do our Philogics report and pull your credit, that doesn't show up on your credit, right?
I like
because
that part.
Now
clean as a whistle. No mortgages. Yeah.
Exactly, right? So because now what the commercial lenders want to look at is the income that's being generated from the property. That's the number one. That's the most important thing now, right? Obviously, any expenses that are coming out of there, that's where you get your net operating income, and that's what they're going to lend on, right? Looking at the DSC again, debt service coverage ratios, etc.
And then they use the cap rate, which is another fancy formula. So cap rates, look it up. It varies a lot depending on the market. Like you were saying, some lenders like certain markets, tertiary markets, which are smaller towns or less secure. Oftentimes, they're not as favorable to lend out there. So you need a solid case for your project in a tertiary market, in my experience.
No, exactly. And you spot on. Reason being is because when you get to those secondary, tertiary markets, you're not seeing massive equity growth, but what you're seeing is a lot of cash-on-cash return, right?
Yes.
You're seeing high cash flow, which the banks love to see, right? So if you find a commercial deal in some of those second, tertiary markets, and it's not cash flowing that well,
then run. It's too expensive.
Yeah, it's true, because that's really the only thing that's going to save you in that case.
Yes. Wow, that's amazing. Well, thank you so much. Like I said, a few minutes to talking with you. I've learned quite a bit, and I hope those that were listening got some value out of this, the Market Mayhem. And next Friday, we're on again. So we're going to have to explore something else, maybe do a case study and maybe run through a case. Like we can show how, I don't know, a young couple or something can get approved. I'm currently selling a property with Rachel, who was watching. And I know she's got a young couple interested in that property, and they're in like a time crunch. We're holding offers on the property. They need to be approved. They need to know how much their house is worth, things like that. So it's not easy. I wouldn't want to be in their seat. I've been there before.
That's being the right now.
Yeah.
It's a little stressful.
So maybe we can run through that next week, and we'll prepare some things. And if people have questions in the meantime, like reach out to me or Charles, and we can answer those live next week. That would be really cool.
100%. And again, thank you, François. I didn't even realize 30 minutes passed up so quickly.
I know, it goes like this.
Yeah, I was really excited You could have kept going, but no, thank you for the platform and the opportunity to speak to you and your viewers, and it means a lot. But next week, let's for sure do it up. Let's make a case study. If you want to talk about young individuals, young families that get into the market, I'm 100% a-okay with that.
Wonderful, yeah, because it's hard. I can't imagine starting over. I mean, it's not easy. So I want to give that kind of value to millennials and younger people that are starting out. Well, like yourself, you're a younger guy. So how would you buy your first property, and how do you go about it? And there's ways around like savings, and there's programs. I know with RSP money you can use as a first-time home buyer. So you could explore that.
Right.
So
100%.
That's awesome. Thank you very much. And I hope you have a great afternoon.
No, thank you, Francois. You as well. You as well. And I can't wait for the next one.
Yes, thank you. Take care.
Take care. Bye now.
Bye.